Howdy, Jacob here. Today we're looking at Denny's Corporation in the hotels, restaurants, and leisure industry. They were founded in 1953. They operate and franchise as a full service restaurant chain under Denny's and Kiki's Breakfast Cafe brands. They are 309 million market cap on 563 million enterprise value. So if you've watched this channel a little bit, I do like to look at insider ownership for smaller companies that I say are under a billion, pretty small. So 2.7% held by insiders. Not enough to turn me off, but I do like to see double digits there. That's just going to tell you that you're investing in a company that management, whether CEO, CFO, board, has direct ownership of the company as well in a good amount. 2.7% isn't anything to brag about. So, I mean, it's fine. It's not going to turn me off immediately, but I do prefer higher. Their growth is essentially flat over the last 10 years. COVID really hurt them. They grew a bit from it, but they're still not at their pre-COVID levels of revenue. With that said, their operating margins have stayed very consistent at 10 to 14%. So that's pretty impressive. With a return on invested capital historically, very impressive. Their income statement shows a repurchase of shares in a heavy amount, 86 to 56. Huge decline there, with a balance sheet of very little cash on hand, no short-term debt, 256 million long-term debt. Not terribly concerned about these capital leases. That's going to be the way it is for restaurants, franchisees, and such. But 250 million debt with only 5 mil cash on hand, a little bit concerning. I do like to say I'm a bit more conservative. I think that if you're going for maximum capital allocation, obviously cash is not going to do much for you, but I think cash is one of those things that can really give you opportunities when you find something to where you don't have to go into debt for. And so here we do see they only have 5 million cash in relation to their 250 million debt. That's definitely less than I would prefer. I do like a hefty amount of cash on hand just for opportunities, not necessarily the best investment, but it does create opportunities for you. And I think, especially as a business, it's good to have the capability to get those great returns, and to have that cash on hand just helps a bunch. But that 250 million debt in relation to their free cash flow is really all over the place. Maybe we're averaging about 50 million. That would have it be about 5 times their 5-year average free cash flow. Their use of cash is mostly share repurchases, a bit on the acquisition side as well. Not so much really anything else. So when we go to our assumptions, I think we're ready for my capital allocation will be on share repurchases, acquisition, and maybe a little debt pay down. So I don't think we're going to be seeing a hefty amount of growth here. I think they can still grow with inflation. I mean, they still have a lot of competition, and I think anything retail, even food, is going to be tough, but people still like to go to restaurants, even if the service has declined extraordinarily since pre-COVID. But I think I'm still confident in seeing a 3%. They have a good return on invested capital, but they're not reinvesting anything. They're really just buying back shares, making some acquisitions. So there's a chance that they could turn that into some good, a good return on investment, but it's not really reinvesting back into yourself to get those rates of return. And so for me, I don't know if it deserves really any sort of premium here. Their margins are pretty solid, so I do like that. I don't like that free cash flow is lower, but I don't like also that it's pretty inconsistent. Maybe I'll stick with around 12 and 10%. And then for, I guess on the enterprise value, I'll change that a little bit since it's almost double market cap. Let me bring that down to 10. But there are a good amount of share repurchases, so 1% for them is only 3 million. Let's say that they produce 50 million. So if we have 10 million plus for stock-based compensation, you have 40 million capable, 20 to buy it. So that's putting in a lot of share repurchases here. This is basically saying that a good amount of capital allocation, maybe 50%, is going towards share repurchases, then 20% to debt pay down, and then the remaining amount for acquisitions. that makes sense to make the company more efficient. So here, I mean, we're saying it looks like a buy here. I might be I might be a little bit generous. Yeah, I guess I am. I'm going to dampen those margins a little bit since even the average is higher, and I think that competition's even greater. So let me bring that down to 10 and 8, but it's still not looking terribly far off. I think I'm more comfortable with these assumptions. Again, the 10p for 3% growth the next 7 years is basically because their enterprise value is so much greater, almost double their market cap. And so even if I have them allocating capital about 20% a year to debt pay down, they're still going to have an enterprise value likely a bit greater than their market cap. So that's why I put a 10p. But I mean, here it might be a company I want to get pretty cheap given the fact that you're not really seeing a lot of growth. And even before COVID, a 14% decline there. And let's see, it wasn't due to, a divestiture either. So I guess there was, 2019, they sold off some property and plant. So maybe they sold off some positions. But yeah, I mean, interesting business. The numbers look fine. This might just be something I'll do a deeper dive in likely soon, but I'll definitely want to get this one a bit cheap. So hope you enjoy the video. Have a great day.